Welcome back to another video about investing. In this short video, I'm going to let Investopedia help me cover 4 types of investments. So, what is a stock? What is a bond? What is a mutual fund? What is an ETF? We'll cover those in this video, and then we'll jump in the next video and we'll cover risk and time horizon, liquid assets, cash and cash equivalents, and money market funds. And then we'll highlight the 4 investment strategies designed to maximize returns and minimize risk. We'll cover those 4 investment strategies when we get together for our weekly Zoom meeting. I look forward to seeing you there. Until the next video, take care.
When you buy a stock, you are buying an ownership stake in the company. The goal is for you to increase the value of your initial investment. Let's explore an example. Awesome Company has a total of 10,000 shares outstanding. That's the number of pieces available. Those pieces are called shares. You decided you want to buy 100 of those shares. Let's assume you paid $10 a share. That means that your 100 shares cost you $1,000. Congrats! Now you are part owner of Awesome Company. So how do you make money? So when you bought your 100 shares, the company was worth a total of $100,000. Let's pretend that Awesome Company had $10,000 a year in revenue when you bought the shares. Well, over the past year, Awesome Company has worked diligently to grow the business, and they now have $30,000 a year in revenue, and their stock price has climbed to $20, making your investment worth a total of $2,000. If the revenue of Awesome Company tripled from $10,000 to $30,000, how come the stock only doubled from $10 to $20? Although the value of stocks generally follow the overall direction of the company's revenue and profitability, the shares of the company are freely traded on the stock market, so ultimately, it'll be based on how many people buy and how many people sell. If there are more buyers, then the price goes up. If there's more sellers, then the price goes down. Next week, we're going to dive into the basics of bonds and how to make money investing in those. In this video, we're going to look at the basics of a bond, what it is and how you can make money investing in it. We're going to look at 2 real-life examples, one from Nike and one from Kroger. A bond is a loan you make to the company. Let's look at some examples. Here are the details for a Nike bond, and here are the details for a Kroger bond. We're going to keep this simple. Let's imagine you're going to invest $1,000 worth of each bond. Here's an overview of how a typical bond would work. When a bond is first issued, it has on it what is called par value, or face value. Typically, that's $100 or $1,000. So let's imagine you invest $1,000 on that day. In return, what you will receive is interest payments, usually twice a year. Let's assume the coupon rate on that bond is 10%. That would mean if you invested $1,000, you would receive $100 a year, or $50 every 6 months. That's typically the way it works, twice a year. You would receive this until the maturity date, where on the maturity date, in addition to your final interest payment, you would receive back the par value of the bond, in this case $1,000. So in looking at the Nike bond, the 3.875% tells you that for the $1,000 invested, you would receive $38.75. For the Kroger bond, the 7.5% coupon tells you would receive $75 a year. If you look at the price of each, the Nike bond is trading at 102.4, while the Kroger bond is trading at 130.3. Why the difference? People have flooded into the Kroger bond that is paying 7.5%. The more people that buy it, the higher the price goes. So what does this mean for you as an investor? The 130.3 means it would cost you $1,303 for the same $1,000 worth of a bond, while the Nike bond will cost you $1,024. The advantage of buying the Kroger is if you pay $1,303, you will receive $75 a year, versus the $1,024 for Nike, where you're only going to receive $38.75 a year. No matter what the price you pay, you're going to receive the interest payments based on the par value of the bond. And at the end of the bond, when the bond matures, you're going to receive back that par value, also known as the face value. That's the purpose of investing in bonds. It's steady, it's consistent, and in theory, it's safer than stocks. A mutual fund is sometimes called a pooled investment vehicle because it pools money together from many investors. It is generally managed by a professional investor called a portfolio manager. The portfolio manager's job is to select and monitor the individual investments for the fund's shareholders. The price of a mutual fund is calculated by adding up the value of all the fund's investments and dividing it by the number of shares outstanding. This is called net asset value, or NAV. Let's look at a hypothetical example. ABC Investment Company launches a mutual fund. This specific mutual fund is only going to invest in environmentally friendly companies. You read through their prospectus to determine if you want to invest in it. A prospectus is a document that every mutual fund manager must make available to investors. It describes the strategy, fees, investment objectives, and many other important details of the fund. After reviewing the prospectus, you determine you want to invest. You decide you want to invest $1,000 worth of this fund. The price of the mutual fund is updated each business day and will reflect the value of the fund's investments. So if the stocks that the fund owns rise in value, the price of the fund will also rise in value. For minimal investment, investors get their investments managed by a professional investor. Diversification. Since mutual funds generally invest in many individual companies, bonds, or other securities, the risk of owning a single investment is reduced. When it comes time to buy or sell a mutual fund, it is rather quick and easy for the individual investor. This allows you to more closely manage your own investments. Next week, we are going to look at setting up a portfolio. We are going to walk through everything from having cash in your savings account to moving it into a brokerage account and placing your first trades. An ETF is an exchange-traded fund. They are exactly like they sound. They are funds traded on a stock exchange. So you could buy an ETF as easily as you could buy a stock in your brokerage account. When you buy an ETF, you're essentially buying an entire portfolio. If you wanted to buy a portfolio of stocks, but didn't want to pick individual companies, an ETF could be a good choice. Perhaps you like picking individual companies, but you don't know a lot about bonds. You could buy a bond ETF. There is also commodity ETFs, investing in things like gold, silver, and oil. ETFs have become increasingly popular in recent years. So if there's an investing strategy you're considering, there's probably an ETF or multiple ETFs that can get you there. One advantage of ETFs is they tend to have lower fees than traditional portfolios. A second advantage is that for a minimal investment, you can invest in an entire portfolio. So if you wanted to buy the S&P 500, instead of having to buy all 500 companies, you could just buy an ETF that tracks the S&P 500. A third advantage is the liquidity that ETFs offer. The most popular ETFs take only a few seconds to get in or out of.